Saurabh Mukherjee, in 30 seconds, if you have to summarize the market mood, how would you like to summarize it?
I think buoyant, but with a degree of apprehension, both regarding valuations and regarding when the Fed will start tightening, because this is clearly a liquidity-driven rally, not a fundamentals-driven rally.
Saurabh, the easy answer, like you pointed out, in this kind of a market, that it's a rising tide, and that rising tide is cheap liquidity which is taking everything up. But ultimately, liquidity will chase fundamentals. And fundamentals for Indian economy for the moment right now are strong. We are like an island, and we deserve to trade at premium multiples.
I think we are trading at a premium multiple, but I think it's worth sort of revisiting this notion that our fundamentals are strong. If you see the last 12 years, right, if you see almost all EMs around the world, we are the EM with the sharpest ROE drop in the last 12 years, starting to 2001-2, and that's largely been driven by a big drop in profit margins over the last decade. And yet over that 10-12 year period, we've consistently stayed the most expensive EM. We continue to be amongst the most expensive EM. So yes, this has been a case for a long time. But I guess at some stage we have to start delivering on the fundamental side, and that's where the concern kicks in as to when will our economic recovery start, because at the moment there is absolutely no evidence of any economic recovery out there, especially on the capex side. There's nothing to suggest that capex will turn either in the next 6 months or even in the next fiscal. I think that's where the concern is arising, that we are probably reaching a stage where the market's getting fully valued.
Saurabh, is the street, or what are your thoughts essentially on where the interest rate trajectory could move? Because yesterday we saw the old series 10-year yield fall sub 7% as well. The new series 6.8. Clearly, there is a bit of dovishness after the Fed meet, and it probably was one reason, along with many, why the NBFCs did what they did yesterday. Where are you on this basket?
So look, I mean, it's pretty clear that neither the Fed nor any other central bank out there really has the guts to tighten meaningfully. We've seen it repeatedly over the last 5 years that if the Fed talks about tightening for say even 3-4 months, equity markets pull back, the Fed gets nervous, they then withdraw their hawkishness, and the party begins all over again. I don't think looking at monetary policy, either Fed, BOJ, ECB is going to take us anywhere. I think where the catalyst you have to look for is the banking system. I think monetary policy will stay super loose, super liquid for a long time to come. There might be the token rate hike from the Fed in December. Where I think the challenge arises in the banking system. I think by keeping rates negative or super low, central banks are destroying the premise of banking in the Western Hemisphere. Whether it's in Japan or in Europe, I think banks are now fundamentally challenged because they can't earn interest rates. And with banking challenge, I think that's where you start worrying about the sustainability of some of the largest banks in Japan and Europe. I think that's where the challenge will ultimately arise. I can't see any central banker anywhere in the world having the courage to bring the equity market rally to an end. It'll arise from sources outside the central bank. Until that time, with inflation benign in India, with monetary policy super liquid outside, what will happen is the RBI will keep pumping liquidity into the market, and our BFSI sector will continue having a party.
Saurabh, hi, morning. Just going through your latest note as well. It's interesting that the consumer discretionary space, the two stocks that you're expected to exit are Hero MotoCorp and M&M. Why is that?
I think there's a whole raft of exits in our annual note about how will the Sensex look like 10 years out. We did this a year ago, and we're doing this again now, trying to gauge the shape of the Sensex a decade out. And it's not just those two names. There's 15 other names that we believe will be out of the Sensex 10 years out, and they in turn will be replaced by 15 new names. I think if you look at the thrust of the next decade, it largely will be around financials. I think financials will have a much bigger role to play in the decade, in the Sensex a decade out than they have now. That is the message that emerges from looking at 5 other economies which have tracked the same journey that we are undergoing. We're roughly a $2,000 per capita income economy now. We will become a $4,000 per capita income economy 10 years out. And in that journey, we will save more, more, we will seek more life insurance, we will invest more, and that will mean BFSI has a much more prominent role to play 10 years out. The other big sector that I think will be much bigger 10 years out is the whole industrials space. I think industrials have a much bigger role to play in our market. Unfortunately, the current bunch of industrials in the Sensex don't inspire confidence, but I think industrials will have a bigger role to play in the Sensex a decade out than they do now.
Saurabh, if I look at the current consumption pattern, it's very encouraging. Bottom of the pyramid categories are not growing. So it's like saying nobody's buying washing powder, but everybody's buying washing machine. Why do we have a divided trend within the consumption space? And a follow-up to that would be that I personally expected the bottom of pyramid category to do well this year because of good monsoons.
So I think you raise a very interesting point. I think, as you're rightly saying, you're not seeing, say, FMCG volume growth, but in the car segment, we are seeing volume growth. Within cars, we are seeing higher volume growth in the more expensive categories. I think the same trend is true in fans, in kitchen utensils. The higher value add products, more expensive products are showing clearly better volume growth. And my reckoning is part of this is because we're not creating blue collar jobs, we're not creating low income jobs, which is why in that segment, in the BOP segment, there really isn't any growth in purchasing power. But it's also true that other emerging countries which have been through our evolution, this jump from $2,000 to $4,000 per capita income, what happens is bottom of the pyramid items become a smaller and smaller part of the market. They become a smaller and smaller part of people's wallets, and aspirational consumption items such as expensive fans, cars, expensive kitchenware, electricals, that sort of tends to boom as you move towards gradually becoming a middle income country with $4,000, $5,000 of per capita income. So I think there's a near-term trend around complete lack of job creation in the bottom of the pyramid segments, but there's also a structural trend over the next 10 years where consumer durables, more expensive end of the auto segment will have a better run. So say 200cc plus bikes rather than say the 125cc bike, expensive fans, expensive electricals. The whole trend in India seems to be towards more value-added, premium-priced items.
So Saurabh, I mean, how are you assessing the market in terms of individual stocks and sectors? Are you finding new ideas to put in money to, or I mean, is it best to just stay invested with the leaders and the performers?
See, it's reasonably clear that a fair bit of money is going into IPOs and QIPs, and like other brokers, we are also trying to capitalize on that trend, that there is a new generation of companies coming through who are seeking capital, and clearly several of these new generation companies have plenty of merit. It's like almost a process of renewal. Yesterday's companies are gradually fading away and a new gen of companies is coming through. That apart, the other three trends I see is the kind of strong or steady decline of PSU banks and the rise of private sector lenders, the big squeeze on black money, real estate and jewelry, and the rise of aspirational consumption, legitimate aspirational consumption, and then the decline of Indian Railways, especially on the freight side, and the rise of the road sector. So three big trends playing out which are giving us stock picking opportunities. We're trying to avail of that and then capitalizing on the IPO and QIP boom that we are currently witnessing.
Identify one stock idea. I'm not talking about today, tomorrow, this month, next month. Let's talk about next 3 years. A stock where you're happy to sit on it for next 3 years.
I'm afraid my compliance doesn't allow me to talk about stock ideas, but I think a theme that I will definitely be happy to talk about is the decline of PSU banks and the way it's opening up a whole new world of opportunity for NBFCs and the smaller banks, especially in SME lending. I mean, it's almost like an opportunity of a lifetime for lenders to grab the PSU bank's market share in SME lending. What's further, I think, easing the path ahead for these smaller lenders is the abundance of liquidity in the wholesale market. Since April onwards, the RBI has made wholesale market liquidity plentifully abundant. And finally, the squeeze on black money, which means that the retail investor clearly can no longer think about real estate and jewelry, and perforce has to think about investing in legitimate financial instruments. So huge opportunity for lenders in our country, growth runway both on the assets and liabilities side.
You were talking about the fact that you're not quite gung-ho about the PSU banking space. Now, whichever analyst we speak with, and if indeed he doesn't have a very strong conviction in PSBs, SBI at least makes it to the list. And for you, that's an expected exit out of the Sensex. Why is that?
think leaving stock specific aside, what we are struggling to see is where exactly the balance sheet replenishment for banks, of the PSU banks come. Remember, if you grow your loan book faster than your ROE, which is almost the norm for most successful Indian banks, you need funding from the stock market, or you need funding in PSU bank's case from your main shareholder, the Government of India. It's not evident that our government has the wherewithal or the desire to support the PSU banks through meaningful infusions of capital. And on the other hand, if you look at the deposit numbers now, it's increasingly evident that depositors are also getting disenchanted with PSU banks as more options open up for savers. So both on the asset and liability side, leaving aside the specifics of the current quarter, the current year, I think both on the asset and the liability side, I expect a long and steady decline for PSU banks, much as we have seen with other PSUs such as MTNL and BHEL, NTPC. It's a sort of same story in sector after sector, long slow decline of PSUs and the encroachment of the private sector. I think the same will happen to the largest PSU banks over the next decade.
What could be the losses for the PSU banks could be gained for the private sector banks as well. But Saurabh, final question from my end at least, maybe a question more, but final question from my end. You spoke at about 9:12, 9:13 about one favorite theme, and that is the focus of black money and the resultant impact thereof. What sectors spring to the fore as a result of that? How do you tie it with the markets?
So one I think clear beneficiary will be the organized financial services sector. Historically, we've saved something like 300, perhaps even $400 billion per annum through physical assets, jewelry and real estate. I think increasingly large amounts of money will be saved through the financial system. So banks benefit, insurers benefit, mutual funds benefit. Hopefully, stockbrokers also get to enjoy some of the financial flows. But the other sector which is clearly benefiting right here, right now, is aspirational consumption. So I think you guys were mentioning something about electricals. We are seeing plenty of spend on home improvement items, tiles, sanitary ware, paints, electricals, consumer durables. So I think that slide away from trying to hoard back black money and buying jewelry and expensive real estate, that shift away towards spending partly on living a decent life and on saving through legitimate financial instruments. I think these are powerful themes, and there's a range of listed plays that one can focus on to benefit from this theme, because I can't see the government relenting on this black money attack.